Kitco News special coverage of the PDAC convention is brought to you by Gold Mining and Uranium Energy Corp.
All eyes are on the Fed this week, with inflation for May coming in hotter than expected, reaching a new 41-year high. Markets are red across the board. So what should an investor do? Who better to ask than Adrian Day? Adrian joining me here at the PDAC convention in Toronto. Adrian, great to have you with us.
Well, thank you for having me.
And of course, Adrian is the chairman and CEO of Adrian Day Asset Management. So Adrian, we've got the Fed meeting coming up on Wednesday. We had that 8.6% increase in CPI. This is now leading to expectations that the Fed may need to be more aggressive on Wednesday. There were expectations for a 50 basis point hike. Powell was saying a few weeks ago that they're probably not going to go up to 75 basis points. But now the markets are thinking that the Fed may be a bit more aggressive than anticipated. What are you expecting for Wednesday's meeting?
Yeah, I'm still expecting 50, to be honest. I mean, this Fed under Powell, this Fed and the one since Bernanke, the Fed likes to telegraph what they're going to do. And I just don't think this Fed has telegraphed sufficiently that there's a 75-point hike coming this week. So I think they're going to stick with 50. You mentioned the inflation numbers. Yes, that gives them more. That reinforces their courage. The same with the jobs report that we had a couple of weeks ago. But let's face it, they're also looking at other statistics that are showing the U.S. economy weakening.
Right.
We know the stock market's collapsing, but I don't think they care about that. But sorry, go on.
Well, no, it's interesting because usually the Fed, it shouldn't, but it does tend to capitulate to what it sees in the markets. But we do have Powell and Yellen and Biden saying that inflation is the top priority. So do you see Powell really having the gumption to aggressively raise rates and to what level?
Well, when I talk about Powell, I'm not going to go like this and talk about gumption, but yes, I suspect that this Fed is going to stay tighter a little or much longer than a lot of my friends expect. We look back to the Powell pivot in 2018, and we look back to 2015 and 2013, the last times they tried to start tightening with interest rates or reducing liquidity. And they caved in very, very quickly. And they caved in the first time the stock market went down. But I almost said this time is different, the four most dangerous words in the investment lexicon. But what's different now is we actually do have inflation. In those past years that I mentioned, we didn't have high inflation, certainly by government statistics, and the Fed was trying to boost inflation. So the only reason for them to tighten before was because, well, maybe rates are too low, so we should raise them a bit. Maybe the balance sheet is too high, we should cut it a bit. But now they've actually got a dragon, inflation, to defeat. Number one. Number two, Number two is that President Biden, has made it clear that this is the Fed's number one priority, and all of the surveys of households are showing that people are more worried about inflation than they are anything else. And we've got midterm elections coming up, so Biden, not so subtly, has said, we respect the independence of the Fed, which is another way of saying it's on you, pal, not on me. Well, if the president of the United States says to you, inflation's your number one job and it's on you, guy, well, maybe you stiffen the sinews and summon up the blood and,
So you do see the gumption kicking in then?
A little bit.
Well, it's interesting because David Einhorn from Greenlight Capital, the hedge fund manager there, he thinks that Powell is going to pivot. He's saying that he sees the Fed doesn't really have the tools to stop the inflation. When the Fed has to choose between fighting inflation and supporting the Treasury, I think it has to pick the Treasury. And at that point, it's best to have some gold. Those are the words from David Einhorn. By the way, his fund is up over 20% this year. So he thinks that the Fed is bluffing here. I
agree 100%. I'm just saying I think they're going to last a little bit longer than a lot of my friends expect based on recent history.
What does that rate look like a little bit longer?
Does it mean a few months? I mean, I agree with him. I think a lot is dependent on what happens. I agree with him 100% that there's a point with the treasuries when they will have to choose the treasury market over inflation fighting. There's a point with employment. If we see unemployment go up dramatically, that's not particularly good for Democrats in the midterms either. So if we see unemployment go up dramatically, I think this Fed, Powell, will choose employment over inflation. But when it comes to the stock of Tesla, do they care at all? I don't think they care if the stock market, in fact, I think they've said they want the stock market to come down. So if the stock market comes down, if the dollar comes down, if even manufacturing declines, I don't think that's going to change their mind. But the treasury market will. He's right on that. I agree.
Okay, so we've got rate hikes, quantitative tightening happening at the same time. Is that enough to cool inflation? And if so,
no.
So to
listen,
what degree? I mean,
the Fed members are living in cloud cuckoo land when their dot plot says that inflation will be cut by more than 50% this year. They're saying by the end of the year, 3.7%. This is farcical. It's as bad as Jerome Powell and Yellen saying that inflation is transitory. They're talking about 2% in 2 years' time. This is just, again, it's fantasy land. So I've forgotten the question now. you got me going.
You got so worked up about the Fed's previous comments that inflation was transitory that basically you're saying they're completely misestimating to what level.
And they cannot control, they cannot bring inflation down. And I'm not the only one saying this. People like Bill Dudley, the former head of the New York Fed, and many other people, Larry Summers, they simply cannot bring inflation down to a reasonable level without causing a recession. They cannot do it. So at some point, they are going to have to make that decision.
All right, but give me an outlook as to a rate you think they'll go up to.
Oh, I think they could go up. What do we, they could go up to 3%.
3%. Yeah. Well, Powell did say that they would go above neutral. We've got a lot of analysts saying that 5% inflation is going to be the new 2% inflation. That if we get inflation down to 5%, that's where we should adjust expectations.
They will declare victory. If they get inflation down from 8.5 to 5, I was going to say 4, but somewhere, if they cut it in half, they'll declare victory at that point. Forget 2%.
Forget 2% inflation as a target in reality for how long?
Oh, for the foreseeable future.
Foreseeable future, 5% inflation.
Yeah.
So you mentioned former Treasury Secretary Larry Summers, and he in fact says that a recession is more likely than not within the next 2 years. Yes. Give me your outlook there.
Well, he's being much more diplomatic than I am. I wouldn't be surprised. I think a recession is almost inevitable. The only thing that will prevent a recession at this point is the administration and Congress doing more unfunded spending, more modern monetary theory, which the Fed will go along with, which means boosting inflation again. In my mind, that's the only thing that will stop a recession coming. I wouldn't be surprised if the US is already in a recession. We had negative GDP in the first quarter. There were lots of excuses about that number. But look at credit card debt. Credit card debt last month went up by the largest percentage amount in history. Look at the savings rate. The savings rate has collapsed in the last 2 months back to 2007 levels. So the consumer is continuing to spend the same dollar amount, but because inflation's up, they're buying far less in terms of volume. And consumers, especially lower income people, are foregoing things.
Right. Well, you mentioned fiscal policy and more spending. And in fact, that's what Larry Summers warned was going to bring us here. Back in 2021, he blasted that $1.9 trillion COVID stimulus package, saying it was the least responsible economic policy in 40 years. And I remind our viewers that Larry Summers was Obama's top economic advisor. So this was pretty strong words coming from him. He warned that it's going to lead to recession, possible stagflation. But you have the Biden administration saying, no, it wasn't necessarily stimulus. It was global supply chain issues. It's the war in Ukraine. It's new COVID strains. It's China lockdowns, basically blaming everything but stimulus. My question is, if fiscal policy doesn't change, if fiscal policy is what brought us here, what do we need to see from fiscal policy combined with monetary policy to get us back? Do we need a fiscal policy readjustment?
Well, when you say do we need a readjustment, I think we need to start working towards a balanced budget. But, that's years in the future at this point. We certainly, there's that old saying, when you're in a hole, first thing is stop digging. We certainly need to stop, as a country, but also other countries around the world, we need to stop spending money we don't have. We need to stop handing out stimulus at every little problem that happens, whatever it is. And by little problem, I mean, I'm not diminishing the human cost of COVID, but, everything that happens, the answer is, spend more money and send more checks out. And, this stuff about Russia, it's a total misunderstanding of what inflation is. And these people, not Biden, but, the people at the Fed, these are smart people. They've surely got to understand and know that inflation is caused by excess money creation. So if you have supply chain issues, you have a war in Russia, you have Ukraine not shipping their grain, etc., that means oil prices go up. It means grain price goes up. It means potash goes up. But that's not inflation. Because if you had the stable money supply, as the oil price goes up, other prices go down to offset it. You only have prices in aggregate move up when you have already had excess money creation.
All right, and we had, I believe, 40% of the monetary supply thrown into the economy during the last couple of years post-COVID. So you said something interesting. You said that these are intelligent people. Surely they know better. No, but surely they know better that excessive stimulus leads to this. Yet we had Powell for the longest time saying that inflation was transitory. Okay, maybe we can say that that is subject to interpretation, exactly what transitory is. But we've got Janet Yellen saying as recently as 3 days ago, and I quote, that there is nothing to suggest a recession is in the works. There is nothing to suggest that a recession is in the works. This is our Treasury Secretary saying this in response to, of all things, a tweet from Cardi B. The rapper, you're looking at me blankly.
I don't know what we're talking about now.
But basically the question was posed to her as a response to a tweet from Cardi B saying, when you all think they're going to announce that we're going into a recession. That was the framework used by a reporter to ask Yellen that question. And she said, there is nothing to suggest we're going to a recession. Adrian, how can the Treasury Secretary make a statement like that?
Well, I think the same way that they made the statement that inflation is transitory, in the same way that Ben Bernanke in 2007 said there's no problem with the housing market. There's no problem with the housing market. So I'll tell you what I think the issue is, and I'm being serious here. The Fed has over 400 PhDs in economics working at the Eccles Building. 400 PhDs. And the problem with those people and the problem with the Fed people, and Yellen, of course, came from the Fed, is that the vast majority of them have spent their entire lives in the Fed. So closeted. So they've never had to make a real decision. If you run a business and interest rates move up, you have to make a decision. Do I increase my inventory? Do I decrease my inventory? Do I raise prices? Do I decrease? You have to make decisions. The people at the Fed don't have to. So they're all working on theory. They're working on theory. But the problem is the Fed uses these models, and they seem to think like a video game. You adjust something here, and it flows through, and this is the result. But that's not the case. The economy is not static. It's dynamic. And if you change, just as I mentioned, business owners, you change interest rates, thousands and thousands of business owners change their behavior, and that changes other things. But the Fed's models are static. We just need to tweak this, and this is a result.
It is surprising that who are supposed to be some of the brightest minds in the room managed to get something like this so wrong. Now, granted, there were some unforeseeable circumstances like Russia's invasion of Ukraine and new COVID strains, not that that would be that unforeseeable, and China lockdown, which is what they're blaming this on. But does this make you question the credibility of the Fed at large?
Well, absolutely. And I must say this, if I may, on a broader subject, Mark Twain, obviously before the Fed, Mark Twain talking about all people in government. And he said, sometimes I wonder if these are clever people who are simply trying to have us on, or if they really are stupid.
Well, that's just it. Is it malice? Is it intention? Or is it stupidity?
I don't think it's malice. I do think one problem is their models, their whole way of looking at the economy is flawed. Again, it's an important point, but they look at static models. And the economy is not static. I mean, the Austrians have been very, very clear on this. You can't have central planning, and the Federal Reserve is nothing but central planning. You can't have central planning because you've got millions of people in the economy who all make their own individual reactions to changes. And there's no way the Fed can do that. But I don't think it's malice. I think there is a natural optimistic bias. I mean, let's put it this way. You are appointed chairman of the Fed. You are in charge of running the economy, as it were. But you make the decisions on short-term interest rates. You make the decisions on money supply. And it's hubris, but it's natural hubris to think, well, of course I can manage this. You know,
all right. So you're saying what many are saying, as the saying goes, don't ascribe to malice what can be explained by stupidity.
Well, okay.
But the expression "don't fight the Fed,"
yeah.
That's always been there. If the Fed is going to tighten, assume that the Fed will successfully tighten. If the Fed is going to inject more liquidity into the market, assume that they'll be successful in doing that, and don't go against the trend of the Fed.
Right.
Does that still apply?
Well, that's an interesting point, because if we look at what the Fed is talking about now, and I'm talking about the most aggressive projections from Fed members, not from commentators, but from Fed members. We're talking about another 50 basis points, maybe another 50 in September, maybe not, and then a series of 25 for the next year. That will put interest rates at less than half the current rate of inflation. That will put interest rates more deeply negative than they were in 1976 at the onset of a great inflation of the 70s. Look at the balance sheet. They haven't even started selling anything from their balance sheet yet. I mean, this is preposterous. 2 months ago in April, they were still buying mortgage-backed securities. They were still buying and adding to the balance sheet. So all we've done so far is let 45 billion roll off. But let's say we get to what the aggressive projections are, but they'll eventually start selling, and they'll be reducing their balance sheet by 95 billion a month for the next 12 months. At the end of 12 months, the balance sheet will be more than twice what it was 2 years ago. The balance sheet at the end of a year will be 10 times what it was in 2008. The economy hasn't grown tenfold since 2008. So the point I'm making here is that even if the Fed does what it says it's going to do, this is not hawkish. This is by no means hawkish. So, and it's certainly not enough to bring inflation down. We're reaping what we sowed at this point.
Can't bring inflation down, and yet a recession is probably unavoidable at this stage?
I think so.
So paint that picture for me. What does this look like?
Well, stagflation or worse, but stagflation meaning a stagnating or recessionary economy with inflation. And if the last time, I mean, obviously the 1970s was the most recent long-lasting case of stagflation. But we've had several short-term incidences of what we could call stagflation over the last 60, 70 years. If you look at stagflationary periods, the assets that did best in stagflations were energy, oil. Number two, gold and silver, monetary metals, gold stocks, and then smaller market equities, and developed market equities, developed market bonds, obviously do badly. Now, were those numbers a little bit distorted as regards energy because of the Arab oil embargo in the 70s? Maybe. I've looked at it, tried to do the math on it. And I think the conclusion you come to is that gold is the best asset to own in a stagflation, gold stocks. Energy and other commodities also did well in a stagflationary period.
So what should investors be doing now?
Good question. Because often, as you know, as everybody knows, often when the stock market crashes, such as we're seeing now, it takes the gold stocks down with it. It takes gold down with it. It takes gold stocks down with it as people look for liquidity. So everything goes down at the same point. But what happens often, and I think you look at 2008, you look at 1987, the gold stocks went down more than the broad market in both those cases, but they recovered sooner and more rapidly. So in 2008, the gold stocks were already back to their pre-Lehman Brothers level by February. And February, the S&P hadn't even hit bottom yet, but the gold stocks had already recovered. I think we're going to see something like that now. So whether it's today or the end of this week or next week, this is the time to be taking advantage of the gold stocks.
Well, actually, the Van Eck Gold Miners Index, the ETF there, last I checked, that was up about 4% year to date, outperforming the broader market.
Today or Friday?
As of this morning, it was up about 4.2%.
This morning. I bet it's not up now.
Well,
I haven't looked, but I bet it's not up now. I mean, the XAU, when we talked, things are changing dramatically, right, obviously. But when we looked at this just before we talked, the XAU was down.
So you would buy a gold miner ETF at this point?
Well, I don't like gold mine ETFs, frankly. That's just a bias because I'm a money manager, so I want people to come to me. No, I don't like the gold ETFs because with an ETF, you're buying a little bit of everything, the good, the bad, the ugly. You're buying the companies that are takeover candidates. You're buying the companies that do the takeovering, and their prices collapse. So I typically don't like ETFs for a market like gold, but that's beside the point. So I would buy the gold stocks. Yes.
You would buy gold stocks. You would buy physical gold. You would buy physical silver.
Correct. And the silver stocks.
Give our investors the best way to position themselves now.
Well, I like individual gold stocks personally, and I think the large royalty companies are the lowest risk way of getting exposure to this market. The major, well-financed, well-capitalized, meaning they have good balance sheets, the major producers like Agnico or Barrick, really solid companies with great balance sheets. That would be my next sort of level. And then I'd also look at some of the second tier producers, which are potential takeover candidates. But there's that wonderful saying, when the filet's on sale, don't buy the hamburger. We might all like hamburger, and with due respect to all the companies here, but when you can buy the best companies cheaply, that's where you start, in my mind.
What are the fillet of companies in your mind that are on sale right now?
Well, a Cisco Mining. Cisco Gold, A Cisco Gold, OR, New York, Wheaton are both Royal Gold. Those three are all quite cheap. Franco, which is the largest, and you'll notice that's the one of the top four I didn't mention, has been my favorite, my largest investment for, 40 years, or 30 years, whatever. So I think it's a great, great, great company. It's just not quite as inexpensive as the others. Agnico and Barrick are two very well-run companies with great prospects ahead of them. You know, Agnico after the merger with Kirkland, and Barrick, I think Barrick is, got lots of growth ahead of it, both in Nevada and also now with the Pakistan copper deposit, and both selling very cheaply. You look at Barrick, for example, it's selling almost at its lowest ever price to free cash flow. That simply doesn't make sense.
Are there other equities not in the commodity sector that you're looking at right now?
Yes, definitely. Obviously, the time to buy is when things are cheap, we know that. And after a market crash, investors should start looking, in my view, for really good quality companies with really strong balance sheets, with businesses that are not vulnerable or particularly vulnerable to a recession, and preferably that pay a dividend. So, and just before I name a couple, I mean, would I buy today? Probably not. I would wait a few days for this dust to settle a little bit. But you look at a company like Nestle, for example, a global blue chip, diversified with operations, both production operations and sales in 100 different countries. Rock solid balance sheet, not vulnerable to a recession at all, if history's a guide, yielding about 2.5%, not an awful lot, but on a historic basis for Nestle, a good yield. So if you can buy really solid companies like that when they're down.
You said you'd hold off on buying. We have the S&P as of this morning down about 20%, the NASDAQ down 30%. How much uglier do you think this gets?
Well, that's a good question, because if you look as of Friday, I don't know if anyone's changed, as of Friday, analyst expectations for S&P earnings were for an increase in earnings. I think it's nonsense. So you only have to discount those earnings projections by a modest amount. You don't have to be a dramatic bear, and you only have to see a lower multiple, which is normal in a lower earnings environment and in a weaker economic environment. And you could see the S&P just on those very modest projections go down another 20% from here. I mean, I think the thing we have to realize, we have to keep reminding ourselves, is that the stock market today, the S&P, NASDAQ particularly, but the US stock market and other markets, are grossly overvalued. They're not just a little bit high, but they are grossly overvalued. They are more overvalued than they were at the dawn of the 1929
so you see
crash.
Another 20% drop from where we are in the S&P.
Yeah, I see no reason why not. I think we're going to see a bear market. Now, most investors today don't know what a bear market is. They think, the older ones, the experienced ones, think of 1987 when the market crashed, and 3 weeks later it was back up. That's not a bear market. They think of 2008, where the market goes down dramatically and everybody panics and everybody calls me and wants to, close their accounts. 4 months later, it's back up. That's not a bear market. A bear market is 1966 to 1980, how much long is that? That's 14 years, when the US stock market was at the same level in 1980, but it was in 1966. That's a bear market. 1929 to 1947 or 8. That's a bear market.
So you're seeing a decade-plus bear market.
Correct.
With the S&P losing another 20%, that would be down over 40% from its highs.
Correct.
That's an ugly picture, Adrian.
We're starting off so high. Now, I didn't say this last time you and I talked, and I haven't been saying this until the last few months. And the reason is because up until the last few months, the Fed was continuing to inject liquidity. If they continue to inject liquidity, that liquidity has to go somewhere, and some of it goes to Bitcoin, and some of it goes to housing, and a lot of it goes to stocks. So stocks do well in that kind of environment. When the Fed starts withdrawing liquidity, even at the timid rate, and I call it timid, the timid rate that they're talking about, when you start to withdraw liquidity, just think about it logically. If the reason that the stock market went up so dramatically over the last 10 years was because we injected liquidity, what happens when you withdraw liquidity? It goes down. It means companies stop borrowing money and doing buybacks. It means, all sorts of things. It means on the 401k, when I'm looking at it, instead of putting 100% into the stock fund, I think I'll put 100% into cash because I'm nervous right now. It has all these implications.
So if I may recap here,
Yes,
Adrian,
please.
you see a bear market lasting for a decade plus. You see the S&P...
Let's just say many years.
Many years, okay. You see the S&P 500 with at least another 20% room to fall.
Yes.
And you see the best way to weather the storm is through holding cash and buying gold?
I wouldn't hold cash for very long. I'd hold cash temporarily until I see better opportunities. But gold, definitely. Gold stocks, silver stocks, definitely. And then don't forget, emerging market stocks or smaller market stocks tend to do well. It seems counterintuitive. We think the world's falling apart, going to hell in a handbasket. If we don't want to own US stocks, why on earth do we want to own stocks in Thailand? And Brazil and places. But in fact, they're precisely the markets do well when you have an inflation and when you have a lower dollar. So if the scenario for a stagflation includes the dollar declining, then those smaller markets are going to do very well.
Okay, final thought on the dollar declining. We are seeing central banks bolstering their gold positions, and we're seeing, according to the World Gold Council, them adding fewer dollars to their positions. David Einhorn, who I mentioned earlier, he sees this as part of a trend against the dollar, with the dollar being weaponized, as we've seen against Russia, and against the dollar with the excessive stimulus that we've seen. One of the big long-term themes that we're hearing is this potential end of the dollar as a global reserve currency.
Right.
Final thoughts on that?
Yeah. I mean, remember, this trend was happening. David Einhorn is correct, again, on this point. But don't forget, we've seen a decline in the percentage of dollar holdings in central bank reserves for many decades now. It's been a long, slow decline. So whereas, the 1990s, early 2000s, other than gold, the dollar was about 80% of foreign central bank reserves. It's now down to about, 60%, including gold. So the decline has been long going, but the weaponizing of the dollar, which has, again, been going on for some time, this is not something that just happened with Russia and Ukraine, but the weaponizing of the dollar absolutely is only going to accelerate that trend. I mean, everybody said, you're a prince sitting in Saudi Arabia, where should we put our cash? Let's put it in New York Bank in dollars. I don't think so. So you're going to see more and more money being put into central bank reserves, being put into non-dollar assets, number one. Number two, you're seeing a trend towards trade in non-dollar terms. We've seen that obviously with Russia and oil and the ruble, but Russia and China, Saudi Arabia and China, we're seeing more of that. But one final thought I would say is, when things are inevitable, they sometimes take a lot longer to happen than you think they're going to happen. Rick Rule, I don't know if he originally...
I was going to say
well,
that.
Rick is very good at quoting other people. I don't know if it's his thing, but he says it. Just because it's inevitable doesn't mean it's imminent.
Yeah.
And I think it's and I love Rick, don't get me wrong. I hope that didn't come across as critical. It's not meant to be critical. The decline of the loss of dollar reserve status is inevitable. But in order for the dollar to lose its reserve status, something else has to replace it. And that's the part of the equation that a lot of people don't really focus on. We look at the dollar and we come up with all the reasons why the dollar should no longer be the reserve currency, but something has to replace it. In 1945, when Great Britain ruled the waves, when Great Britain lost the reserve currency, when the pound lost reserve currency to the dollar, in 1945, it was obvious to everyone. It was obvious to everyone, including the old colonels in their clubs in London, that the US was replacing Britain as the world's leading political, economic, and military power. It was obvious. If you look today and people look at China, we can argue that China's going to be the world's largest economy, it's going to be the world's largest military, but it doesn't have the depth of capital markets at the moment that you need for a reserve currency. The dollar in 1945 did, China doesn't. And secondly, the US and the West simply don't want to hand over to China. So this is going to be a very, very messy period. I mean, for Britain, we had a declining economy for 30 years. Eventually, we went begging bold to the IMF for loans. We had Suez, where the US had the temerity to tell us what to do. But it was, generally speaking, a friendly trade-off from Britain to the US. Yeah. The point I'm making now is that the world as we see it today, that is not going to be a friendly trade-off.
Yeah, we are hearing more and more discussion of a bifurcation of the monetary system, bifurcation of the trade system, and perhaps some commodity-backed digital central bank currency. Yeah. Adrian, we're going to end with a quote from you. As you say, Rick Rule likes to say, inevitable is not necessarily imminent. Do you have a phrase that we can wrap up this interview with?
Well, if something's inevitable but not imminent, it may take longer to start than you think, but once the trend starts, it tends to unravel much more rapidly than we think. That is nowhere near as pithy.
But it's pretty good. It's pretty good. Adrian, thank you so much. Really appreciate it. Adrian,
well, thank you. Thank you very much for having me.
Kitco News special coverage of the PDAC convention is brought to you by Gold Mining and Uranium Energy Corp.